Don't ever pay off a loan early. Wait, what? Alright, so hear me out. Have you ever experienced or heard of other people saying that the credit score dropped after paying off a loan? There's a reason for that. There might be plenty of reasons on why you may think that paying off a loan early is the right thing to do. And yes, you're gonna be saving some money on interest and that peace of mind of being debt free. But if you care about your credit score and think about paying off your loan early, you need to watch this video. What's up, winners? My name is Naam. If you're new here, welcome. Here we talk all things personal finance and credit. Start now by subscribing so you don't miss out on any future videos. Before we get into today's topic, I would like to thank today's sponsor, Cover. Cover is a mobile-first insurance brokerage that works with over 30 insurance companies. So being a broker, they'll help you search for the best rates for your car, home, and renter's insurance. They have some of the lowest rates, and car insurance can start as low as $35 a month. Since they are mobile focused, you can easily get a quote within a couple of minutes, and you can even chat with your advisor only through text if you like. So say goodbye to awkward phone calls or long wait time. A rare benefit that I have never seen with any other insurance broker offer is that they can give you a credit line up to $250 just to get started. Additionally, you can reuse a credit line again for future installments or a new policy. So while you're building up driving experience, you also build credit. Save money on insurance and get started with Cover today. Link in the description. But now let's dive into today's video. To wrap your head around why not to pay off a loan early, first you need to understand what an installment line of credit is. This is a type of financial product that has a predetermined length and terms. This is what is commonly known as a loan. For instance, mortgages, auto loans, student loans, and personal loans are the most common kinds of installment lines of credit. With all of these loans, you know exactly how much you need to pay every single month and for how long. This is very different from a revolving line of credit, such as a credit card. Revolving lines of credit is where you have a certain amount that you can borrow or a credit limit that you can use, and once you pay it off, you can re-borrow once again. So this is an ongoing cycle as long as you pay on time and have available credit. This type of credit line tends to be higher risk because your payments and balances fluctuate. Borrowing money from an installment line of credit most of the time is less expensive than borrowing money from a revolving line of credit. Depending on your credit worthiness, your personal loans or car loans can be in the single digits. But if you were to borrow money from your credit cards, the interest rates that you could be charged could range anywhere between 14 to 25%. One of the drawbacks with loans is that you may not be allowed to pay off your loan early without a prepayment penalty. On the other hand, this is hardly an issue with credit cards. So if your loan does have a prepayment penalty, you really have to assess if the interest savings outweighs the penalty. If it does, then it may be worth it. If it does not, then just follow the terms of the loan and reap the benefits of improving your credit score. So how does paying off a loan early can affect your credit score? If you are a person who follows Dave Ramsey, you probably think that this is really bad advice because credit card debt is bad, loans are bad, auto loans are bad, and cash is king. I actually do like Dave Ramsey quite a bit, and his teachings are very good. He mainly focuses on getting out of debt and not being slave to the lender, so he does not care whatsoever about credit. But for me, I'm all about optimizing credit to your advantage. So paying off a loan early can either positively or negatively impact your credit score in the short term. But it really comes down to your personal credit profile, such as mix of account types, account balances, and other factors. But what is most commonly seen when you pay off a loan is that you tend to see a drop in your credit score. The reason on why this happens is that this credit line or trade line becomes closed once it's paid off. Unlike any other credit card or revolving lines of credit, that account remains open even if you don't put balance on it for months ahead. But once you pay off a 5-year loan, once it's closed, it's closed. Your FICO score has 5 main components. This includes payment history, amounts owed, new credit, length of credit, and credit mix. Once an installment line of credit closes, this reduces your credit mix, which plays 10% of your overall score. This really has a bigger effect if you're paying off your only installment account. So let me give you an example. Let's just say you currently have a car loan and a personal loan. You decided to pay off your personal loan early to reduce interest and to get rid of debt. Awesome, more power to you. By paying off this personal loan earlier, this will most likely have no negative impacts to your score since you currently still have an installment line open. So you can possibly see a credit boost. On the other hand, let's just say that you took out a personal loan for a week in Vegas, and it's your only loan. Once you pay this account off, you will no longer have a mix of open accounts. In this instance, this will bring your credit score down. I get it, this is messed up. To get the highest possible credit score, you usually have to carry some sort of debt. Another reason on why your score could drop is that that loan is the only account with a low balance. The balances that you have on open accounts play a huge role in your credit. So let me give you an example. Let's just say that you have 2 credit cards and a car loan. Both of the credit cards have a $5,000 limit and you have a $4,000 balance on each one of them. Meanwhile, your car loan only has $1,000 remaining from a $15,000 loan. If you decided to pay off a car loan early and only pay the minimum on the credit cards, now all of your active accounts would have high balances in utilization, which can drop your score. You've probably heard of what credit utilization is. This is usually represented as a percentage of the balance compared to your credit limit. So the lower, the better. Credit utilization tends to hold more weight since it does fluctuate. Loans does have a utilization as well, but it is factored into your credit much differently. So at the beginning of your loan, your score may drop quite a bit because you are taking on more debt. Once your loan is near the end, the difference between the original balance and the current amount is much more. So your loan utilization is lower, which only benefits your credit score. But sometimes, after paying a loan, you might think it was the thing that damaged your score, while it could have been something else. You might have applied for new credit that month, or you had a higher utilization compared to the previous month. So before you blame the system, take a deep dive on your credit report to see what was the actual cause. Now, closing any type of loan can have a negative impact on your credit score. It does not mean that it erases the payment history off your credit report right away. Positive information still gets reported to the credit bureaus 10 years after the account closes. So for most of the parts of your credit score, open accounts carry much more weight compared to closed accounts. So by knowing the downsides of paying off a loan early, when does it actually make sense? While your credit score is an important factor when lenders decide whether or not to lend you money, it is not the only thing that they look at. For instance, whenever you're looking to buy a home, your debt-to-income ratio plays a huge role. In a nutshell, what debt-to-income ratio is the amount of debt that you currently have compared to how much money that you make. For example, if I have a combined monthly debt of $1,000 and I make $4,000 a month, my DTI is 25%. Ideally, most mortgage lenders want to have a debt-to-income ratio lower than 36%. But it can go as high as 43% and you can still qualify for a mortgage. But you do have to keep in mind that whenever you do decide to get a mortgage, not only your debts play a role, but your estimated future housing costs does as well. So by lowering your overall debt by paying off your loans early, this may make it easier for you to get approved for your next mortgage, even though your credit score has gone down. With most lenders, once your credit score is above 740 or 760, you usually qualify for Tier 1 credit. If you are placed in this tier, you generally will qualify for the best interest rates available. So if your credit score is in high 700s, paying off a loan early and taking a slight dip may not affect you at all. Another reason on where it would make sense is that if you have multiple installment loans. So let's just say that you have 2 car loans. If you decide to pay one of them off early, you most likely not see any effects to your credit score, and you may actually see an increase. The reason behind this is that you still have an auto loan on your credit report that is still active. Additionally, if you have multiple installment loans, such as a student loan, a car loan, and a personal loan, paying one of these loans early may not have no impact on your credit score either. Where you will see the most impact to your credit score is if you only had one installment line of credit and you decide to pay it off. By having multiple installment lines of credit and the financial means to do so, paying off one of your accounts early would most likely benefit you. Another reason on why paying off a loan early makes sense is the math. Whenever you pay off loans that carry interest, you save that money that you were previously putting towards the monthly payment. Again, this really depends on the type of loan that you do have. With amortized loans, where you pay off interest mostly towards the beginning and more of the principals towards the end, it may be more difficult to save on interest. Plus, you have to figure out whether or not that loan has any early payoff penalties. With some amortized loans, if you pay an extra payment or pay early, the payments can go directly to the principal. This is where you would maximize interest savings and payment history, but more on this later. Like I said before, by paying off your loan early, you can save money on interest. But you really gotta think whether or not the interest is worth saving. If your interest is 3% or lower per year, is it really worth paying off that loan early, or your money is better invested elsewhere? Since the yearly inflation in the US is roughly around 2 to 3%, if your interest rate is the same as inflation, you're really not losing money because you are paying your loan off with money that would be worth less in the future. The next reason on why you may consider to pay off a loan early is to be debt-free. Being debt-free gives you the peace of mind that you would not have to worry about paying someone back. I had never met a person who complained about being debt-free. Whatever your monthly payment is, it goes directly back into your pocket or towards something else. To be completely honest, being debt-free is probably more worth it than getting some points deducted from your credit score. So with that being said, whether you care about your credit score or not, there is a much better strategy that you can take to pay off your loans. The biggest portion of your credit score is your payment history and the amounts owed. This accounts for 65% of your overall score, so this is where your main focus should be. The longer that you have an excellent payment history and the lower balances that you have on open accounts, the better your score will be. So the strategy in a nutshell is that once you have the ability to pay off your loan early, you would want to pay off as much as you possibly can, meanwhile keeping a small enough balance to keep the account open as long as possible. I do go into great detail with this kind of technique in the video up here if you guys want to check it out. If not, I'll explain it in this video in layman's terms so you can follow it as well. So let's just say that you have $5,000 remaining on a loan and you have the ability to pay it off today. So rather than paying off the $5,000 off right now, I'll pay off 91% of the balance and leave the remaining balance there until near the end of the term. This would translate to paying off $4,550 now with a remaining balance of $450. So depending on the loan that you do have, since you pay that much money up front, your next due date for your next payment can be months or years down the road. This way you can benefit from a long payment history plus reduce the interest that you would have to pay. Again, this really just depends on the type of loan that you do have. With some loans, there's no way to avoid the interest charge, but you can still benefit from paying off the majority of your loan early while making the minimum payment to have a longer payment history. So depending on your credit score and your financial position, paying off a loan early can actually cost you more money if you are trying to seek finance. If your credit score is below 740 and looking for a new line of credit, just be cautious about paying off that loan early. You may want to consider getting a line of credit first prior to paying off the loan so you can optimize your chances of getting approved and better interest rates. But if you do have a great credit score, like in the high 700s, paying off a loan early may not affect you at all whenever you are trying to seek for new lines of credit. So just keep in mind that this is a very personal decision. If you have the financial means to pay off your loan early and rather be debt-free, I would just say go for it so you can have that peace of mind and you can just use that cash elsewhere, such as building an emergency fund. Now, I want to turn it over to you. Would you rather pay off the loan early or use that strategy that I mentioned previously to optimize your credit? Let me know in the comments. I'll see you guys in my next videos.